When people achieve $1 million, they tend to regard themselves as successful because obtaining that amount is usually the benchmark of wealth. When you've accumulated that much amount, people will most likely expect that you are living in an expensive house, driving a fancy car, and have a successful career. In today's world, however, this isn't the case anymore. Having $1 million won't make you afford the exact same purchases as 40 or 50 years ago. Today, just because someone is a millionaire doesn't mean that they are wealthy or even close to financial independence. If you're wondering what kind of lifestyle you will get with accumulating $1 million, as well as how much money you can get in investing that money for your retirement, then you're watching the right video. Hi! Welcome back to Grayson Finance. In today's video, I'm going to be talking about what to expect from $1 million in retirement savings. Looking at the yearly returns of your portfolio and deciding that it is okay to withdraw your gains for your retirement is quite easy. Assuming that you will be getting 12% investing your $1 million will make you able to gain $120,000 in just 1 year. With that amount accumulated, you might want to withdraw it all and spend it. After a year, you might get a return of just 8% and be able to get $80,000 annually from your investment of $1 million. While this decision can work, a problem may arise from the uncertainty of the exact percentage of returns every year since it changes drastically yearly. Let's take, for example, in 2018, the S&P 500 had a return of -6%. With your $1 million, it could have been a $60,000 loss for you. On the brighter side, in 2019, the S&P 500 returned almost 29%. With your $1 million, you could have made $290,000, making it a very profitable year for you and other investors. Even with the possibility of a huge return, however, there's always a risk of loss and stagnation. Another problem that arises when thinking about withdrawing your entire annual gains is that you are not taking inflation into consideration. Because of inflation, the value of your $1 million will surely go lower and lower as years go by. The average return of the S&P 500 is 10% per year. With that, you may consider that in the first year of your retirement, you will have $100,000 in income on average. While that amount is pretty okay, you need to understand that after a few years, $1 million would have lost most of its value. Technically speaking, you still own $1 million and still gain an average of $100,000 every year. As previously mentioned, you still won't be able to afford the same purchase you were able to afford years ago with the same amount of money. The average inflation rate is 3%. While that isn't that much inflation now, after 24 years, the value of your million will only be as half as it is valued now. Different opinions are made on just how much you can withdraw safely from your investments every year. Theoretically, you can just withdraw all your gains, but as discussed earlier, it is not really a sustainable option for you. Some people would suggest that it is safe to withdraw 3% yearly in consideration of how unpredictable the market can be. Other people would suggest a higher percentage of 5% as a safe percent to withdraw because there had been no extended bear market in a long time. Well, a good suggested safe withdrawal would be 4% as a rule of thumb. However, don't confuse this with the portfolio's overall returns. This is strictly the withdrawal rate. For instance, you can withdraw 4% of your portfolio during the first year of your retirement, but of course, with adjustments for inflation in the following years. With that, the amount you can withdraw in your first year is $40,000. If inflations rise up to 3% the next year, you can withdraw $41,200 next year. As your cost of living rises, your withdrawal rate should rise dependently too. With this, you will have little to no chances of running out of money. Additionally, the 4% rule actually has a lot of factors taken into consideration as well as some bases. The number one factor is that it is based on someone whose portfolio is comprised of 50% stocks as well as 50% bonds. Someone like Dave Ramsey, a conservative investor, would suggest that you should keep all your money on growth stock funds, leaving no allocation for bonds. He believes that bonds are equally as risky as stocks and with very low possible returns at that. While everyone has their own preference on how they make up their portfolio, you can consider the suggestion of having more exposure to bonds and lesser to stocks as you age. This is because higher stock allocation equally gives you a higher average return and risk. Another factor of the 4% rule is it is based on a 30-year retirement. If you're someone who plans to retire in their 30s or 40s, then having 4% is too much for your funds, and it will dry up very soon. However, if your plan is to retire for 30 years, you will have little to no chance of drying up all of your funds. Well, of course, no one knows how long they are going to live, so it may be a problem in planning for a 30-year retirement. If you knew when you would die, you could have budgeted your money better and know how much you're able to spend every year from your funds. But of course, that is still impossible to know. Some people, however, would plan on spending every last bit of their money while they're still alive because none of your material goods travel with you after your death. I believe that's a careless choice to choose. Because we don't know exactly how long we're going to live, it is unwise to spend everything you have quickly. After reaching the age of 65, you are only expected to live less than 30 years more on average. That number, however, is just the average. Investors should always play safe and plan for a long retirement. Cutting it too close will only make you end up going broke. There will always be a risk, whether big or small, in running out of money on your retirement. That is why you need to manage that risk properly before you retire. Take into consideration your health as well as genetics to get an idea of how long you will be able to live. In the previous 30 years, the average life expectancy has risen to 5%. That is why, if you're planning for the retirement of more than 30 years, 4% is a little too much to withdraw for you. Depending on what age you retire, how long you've contributed to the program, etc., the benefits you are able to get from Social Security vary. On average, a person can get $18,000 per year. With your portfolio withdrawal, you will be able to get $58,000 annually in income. Taxes also vary from person to person. How much you'll owe depends on what kind of retirement account you use. For example, traditional IRA and 401k are taxed as ordinary income. In addition to that, the taxes you will need to pay also depends on whether or not the state you are residing in has an income tax, your filing status, and your income bracket. In conclusion, always remember that withdrawing the entire gains of your portfolio is an unwise decision, as your money will only decrease in value because of inflation. The withdrawal you can get safely should depend on what your portfolio is made up of, your expected years of retirement, and other factors you need to consider. You can get up to $58,000 per year as an individual, depending on your circumstances. Always remember that you should become conservative when faced with uncertainties in projecting finances on your retirement. Thanks so much for watching! I hope you found this video helpful. Make sure to click like, subscribe, and hit that notification bell to keep you updated on new helpful videos like this one.